In our latest financial deep dive, we're continuing our coverage of the yen carry trade, a market force that's creating ripples across global finance. But the story doesn't end there. Recent data and insights reveal even more layers to this complex narrative, especially concerning Japan's significant moves in the bond and stock markets. According to a recent report from Reuters, Japan has emerged as a major buyer of foreign bonds, snapping up a net 1.5392 trillion yen in foreign bonds for the week ending August 10th. This follows a previous surge of 677.7 billion yen the week before. Japanese investors also purchased 453.5 billion yen in foreign bills while offloading 328.1 billion yen in foreign stocks. These aggressive buys signal that Japanese investors are seeking safer, higher-yielding assets abroad, possibly spurred by the weakness in foreign currencies. This activity ties directly back to the yen carry trade. There's anecdotal evidence suggesting that the revival of carry demand is playing a significant role here. With the Bank of Japan, BOJ, hiking rates in July, a move that appears to have been absorbed by the markets, Japanese yields have come off their highs, making overseas bonds even more attractive. But what does this mean for the yen? If we look at the data from Thomson Reuters, the yen carry trade is indeed popping again, with net short positions on the yen surging as the dollar-yen exchange rate climbs. This resurgence could be a reaction to Japan's continued bond-buying spree, as investors borrow yen to invest in higher-yielding foreign assets, betting that the yen will stay weak. But there's another side to this coin. The Japan Exchange Group has released data showing a significant outflow of foreign investments from Japanese stocks and futures, especially in the week ending August 2nd, where foreign investors pulled out 552.43 billion yen from Nikkei 225 futures alone. This is a stark contrast to earlier weeks where inflows were more balanced. It suggests that foreign investors may be hedging their bets, pulling back from Japanese equities as they eye the potential risks posed by a volatile yen and fluctuating global bond yields. So, what's the big picture? Japan's aggressive bond purchases and the revived yen carry trade point to a complex and potentially risky global financial landscape. Investors seem divided. While some are capitalizing on the current environment, others are retreating, likely wary of the underlying volatility. From my perspective, these moves by Japanese investors reflect a broader uncertainty in the market. The BOJ's policies, global interest rate dynamics, and the fluctuating yen are all creating an environment where the stakes are high. While the carry trade offers potentially massive rewards, the risks are equally formidable. Investors should be vigilant, as the ripple effects of these trades could lead to significant shifts in global markets. As we keep a close eye on Japan's financial maneuvers, the real question remains: how long can this game of high-stakes financial chess continue before the board is overturned? Stay tuned as we continue to unravel the implications of these developments and what they mean for global markets and your investments.